So part 4 of this month's series, as we wrap up our first month's discussion of systems trading and my adventure into it, is going to be the 3 C's of trading, and I really should say the 3 C's of systems trading. Now remember, I've been going through the process with you all throughout the month, just kind of to recap those of you that might be joining us for the first time tonight. I've been going through the process not of coding and so forth, because quite frankly, I'm not going to be the one coding it. I don't know how many of you have a natural interest in coding. That's not something I'm even remotely interested in. Not that it isn't something that's worthwhile learning, but of all the things that I need to be taking my time out in the day, that's just not one of them that interests me, okay? I would love to be able to rely on myself for such things, but to force myself to be interested in coding, not my cup of tea. So there are people who are much better than and more efficient at it than I am, and that's who I'll rely on. And basically, I think for me, rather than learning how to code, what I've been trying to do is get into a whole other level of detail and depth as far as what it is that I do on a discretionary basis and give it definite rules, step-by-step rules. For example, and let's get right into the chart here, because I'm going to give you one of the examples of what I've been trying to determine for myself. And by the way, I'm not going to make this a black box system. I have little or no interest in locking it in any way. I'm going to actually be using tools that that you're probably already familiar with, that I've been using for pretty much my entire trading career, and that's the 34 EMA wave and the grab candles. So my systems will be based upon tools that I'm already using on a discretionary basis and want to automate. I'm taking that manual transmission and making it an automatic transmission. And in that, I'm simultaneously removing a lot of the emotion and time delay and bias that comes along with the discretionary process. None of us are Vulcans, okay? So how do I take what I do on a discretionary basis and put it to work 24 hours? I mean, I've got to sleep. I have no interest in being in front of my computer for more than about 4 to 5 hours at a time. I really don't believe I'm capable at a high level of attention and therefore trading for more than about 4 to 5 hours at a time. If you think about some of the world's best athletes, you start getting into a game that lasts more than 4 or 5 hours, I just don't believe emotionally, physiologically, we are designed to really do anything for an extended period of time like that at a high level. If you find yourself pushing past your particular clock, for me, like I said, it's 4 to 5 hours. I know some traders that could sit and do it for 8 or 9. Okay, everybody's different, but I can find myself kind of ebbing and flowing through the day. Some days sometimes I'm kind of, my mind wanders off and then it comes back into focus, and you've got to notice these things about yourself when you're a discretionary trader. But when you're a systems trader, you're taking those discretionary decisions that you would be making in manual order entry, and you're letting a piece of software or an EA or a custom indicator do it for you. Okay, but let me show you one of the decisions that I'm having to make right now, and I'm going to jump on over to the MT for the IBFX4 platform, and what you see in front of you right now is a daily chart of the Euro-US dollar. The indicators that we have running on it right now are, of course, the grab, which color codes my candles. I've got the 34 EMA wave, which you can see in the green, the blue, and the red moving averages. And then there are 2 other moving averages on the screen. A white thin line, which is the 20-period simple, and the thicker white line, which is the 200-period simple. Okay, so a 20 and a 200. If you want to throw a 50 and a 100 in there, that's fine. For me, it starts getting a little noisy, but that 20 and 200, along with the wave and grab, are pretty much the minimum that I need on the screen to make some decisions about support, resistance, and market trends. Okay, so how do I tell a system that I feel that there's been enough bullish or bearish sentiment and momentum built up to begin to translate into a trend. You know, the sentiment, I utilize my grab candles. My trend, I utilize the 34 EMA wave. So if we were talking from a discretionary standpoint, and again, I can only share with you the process by which I'm going through this. As I've mentioned for every single talk we've had this month, I am not a seasoned, experienced systems trader. Okay, what I've been trying to show you is the transparency of thought and process and the struggle, really, of a lifelong discretionary trader venturing into not supplanting my current approach, but supplementing it with possibly this more systematic strategy. So in terms of, if we were just trying to determine momentum, sentiment, trend discretionarily, how would we do that? Well, you know, we'd start off with looking at the particular time frame and squeezing in the market memory. This is a daily chart of the fiber. So knowing it's a daily chart, an end of day time frame, I'm going to do what? I'm going to go ahead and squeeze in 1 year, right? Now, I know that 1 year is not necessarily going to squeeze in perfectly. I might end up a little less or a little bit more. But you know, again, it's about looking at the 52-week highs and lows, and I think what is the most psychologically relevant amount of price action from which to make a judgment call about dominant trend, about the cycles and the market trends this 1 year has presented for this pair. Okay. And one of the things that we'll do once we have this market look back is take a look at the angle of the 34 EMA wave within this view. Now, it's really important that we start from the market look back, this market memory, to take the angle of the 34 EMA wave, because too much, we could artificially steepen the wave, and too little, we could artificially flatten it out. So in the interest of consistency and the psychological relevance of price action, what are the price levels, and what is the cumulative amount of price that will give us levels that the market's most likely to react to? That's what I mean by psychological relevance. So from that viewpoint, I can make a judgment call about the angle of these trio of moving averages. And based upon that, I can see they're moving up in what I would call a 12 to 2 o'clock angle, and I've got a markup trend. Now, that was all done visually. That was all done manually. How do I take that, which is this process we just did, market look back or market memory, to market trend determination by the angle of those moving averages? That was all done visually. So how do I tell a system that after the market moves up at 12 to 2 o'clock, I'll start thinking about swing trading? You know, that's one of those things where, how am I going to assess the angle of this wave in a way that is completely systematic? And how do I account for some traders who might be using the system who would rather have a more aggressive interpretation of a trend versus more conservative? I want this to be more of a gray box. I want to be able to adjust for aggressive versus conservative trading because I tend to go through that whole spectrum myself. I want to lock myself in. I don't think there's one perfect setting. Okay? So I've settled on, again, in this process, I've settled on maybe it's going to be a certain number of candles that go green. So for example, I know I'm not going to have an uptrend without a certain amount of consecutive green grab candles. Maybe that number is 5. Okay, after 5 green grab candles, I can say that I've got a markup trend. I know I've got bullish sentiment and bullish momentum, but at that point I could say, at the very least, I've got what could be a very fresh transition to a mark-up market trend. If someone is more on the conservative side of things, it could be 10. Maybe it could be 5 green candles plus a certain percentage or a certain number of pips. So if those 5 green candles just barely close above the 34 EMA wave but have not moved at least, made higher highs by 30 pips, perhaps that's not going to be enough. Do you see how there's some fine details I can start to build in? So what have I so far just discussed with you? Consecutive, think about it for a moment, consecutive green, and again we're talking about uptrends, right? So consecutive green candles, how many? I just mentioned 5 might be the minimum, right? And of course I'm going to have a setting within this that'll let you make it 10 or 3 or whatever you want, but I think 5 is a good place to start. Then I might have a second setting that says it's either a pip or a percentage that says we must make, for example, higher highs or higher lows by a certain amount of pips or percentage. If I don't make higher lows by, say, 10 pips, I don't make higher highs by, say, 30 pips within the context of an uptrend, that may not be enough. And I don't know that these are going to be the final determining factors, but these are ways that I'm going to communicate to this system that I have identified a markup trend, starting with the grab, going to then price movement. Okay? As far as the entry goes, once I've made that determination about whether or not I've got an uptrend that is now confirmed, 2 levels that I know that we watch, we've talked about this many times, is the aggressive 20-period simple entry and the more conservative 34 EMA high. So now we're talking about position sizing. Now we can have the system, if it is going to automatically execute, one of the things that I can tell the system is perhaps at the 20-period simple, the more aggressive, I'm going to put in 1/4, 1/3, who knows, of my position sizing. So if my overall position sizing is, for example, 4 lots, 1 is going to go in at the aggressive 20-period simple, while the other 3 will go in at the more conservative level. So if we don't correct deeper than a 20-period simple, which could be shallow, at least I have some skin in the game, but I'm not top heavy in my position. I did not go in too big at an aggressive level. Now, these are just some of the processes by which I'm trying to determine taking this visual assessment and giving it some definite rules, and rules by which they can be tweaked by the individual. Okay? Now, what does this have to do with psychology? This is what you guys came here to talk about, right? So what does any of this have to do with the psychology of the 3 C's of trading? Well, first of all, we've been talking really about the first C so far, which is comprehension. Now, you're going to find out 2 things tonight. I love alliteration. The 3 C's are comprehension plus confirmation equal confidence. That's my formula, and I think all trading psychology, inner psychology, we have inner psychology, how do we interpret the market through the filter we call our brain, and then there's external psychology, which is really the more important of the 2, which is how do we get out of our own way and interpret the message of the market. I think the main goal of internal psychology is just to clear our minds. Once we have the knowledge, just let that go to work. Dump the biases, dump the baggage, dump the bad experiences, definitely dump the good experiences, and just clear your mind. When your mind is quiet, you'll actually hear what the market's telling you. Lousy traders have loud minds. I've seen far too much of it. So the job of inner psychology is just to get the pig in the head, as I like to call it, out of the way so you can hear what the market is telling you. Okay? But we are talking about inner psychology here today, and I'm not trying to poo-poo it. I'm not dismissing it by any stretch. I just think there's far too much made of inner psychology. There seems to be people whose only job out there is just to discuss inner psychology. And that's fine, but at some point it becomes a little too self-indulgent, in my opinion. So I just caution you from getting stuck in that loop of constant self-introspection, which is fine, but not at the expense of realizing that the only job of inner psychology, again, is to allow you to be a better interpreter of market psychology. At some point, you got to get good at that. That's what trading is. Okay? So, comprehension. So what we've been talking about for the past, 20 minutes here, 15 minutes, has been this idea that you've got to understand the steps in detail of the strategy that you want to execute. The first and foremost being when you even want to use it. You know, there's a lot of great strategies out there. I would be a fool to tell you that the 4 that I use are the only ones that work. They're the ones that work for me. But I think what every great trader gets very good at is in finding that magic strategy. We all know it doesn't exist. But what they get very, very good at is knowing when to use it. Okay? A great carpenter knows what tool to use depending upon what the job is. Any good craftsman knows that. There's 1,000 tools out there, right? They all have their uses. I'm never going to run around saying a hammer's the best, because if I have a bag full of screws, it's going to do me no good. So realize right tool for the right job. So for us, that turns into the right strategy for the right market environment. So our first step in all our trading is how do I consistently identify what the market, the external psychology is, and that's just another way of saying what's the market trend. That's Charles Dow 101, 100-year-old discussion, literally, 100-year-old discussion. So comprehension is you've got to know your strategy inside out, because how the heck are you going to go ahead and automate it if you don't know how to communicate to a programmer, or if you program for yourself, put these rules, these steps down in such a way that now you can actually code it. Okay? So comprehension is the first step. If I haven't drilled that home by now, if you don't have a complete, thorough understanding of the strategy, there's no way you can get to step 2 properly. Now, a lot of people like to skim over step 1. You know, sometimes the constant study is just a speed bump on the way to the excitement that we perceive trading is. Good trading is surprisingly boring. It really is. You see anybody in the room, if you're in a trading room, hooting and hollering, you know, tick-tock, they're going to blow up. You can set your watch by it. Good trading is unbelievably boring. So for those who like to skip all past the learning process and get your hands dirty and jump right into testing things out, which is step 2, confirmation, just remember there's a certain amount of dues we pay in the learning process, which means a lot of study, a lot of observation, and not a lot of trading. The trading, or the testing, or the confirmation process comes when we think we understand it enough. And, you know, by the way, we might have to go back to the comprehension process after a little bit of confirmation, because at that point, any weaknesses in our understanding are then exposed. The confirmation process is sort of a litmus test for our understanding, okay? And we go on to taking what we know and testing it out. So let's jump on over to my chalkboard, if you will. We've been using Word. I'm not a big PowerPoint fan. You guys know that. I like using Word and kind of making live notes as we talk. So what's the formula? Comprehension plus confirmation. Now, confirmation is a process by which we just get into the market, start either with a micro, a mini, or demo, and start to test out this strategy, not only just our understanding of it, but whether or not we can apply it at the right time to see how it works. Now, as we continue to do this, and as we continue to test our knowledge of the of the system, or I should say of the strategy. Something happens quite naturally. It's not something that we do forcefully. Something happens naturally, and that's this process of confidence. I don't think the world is designed to make you or I confident. Okay, it's something we've got to do. But the doing, to me, is the knowledge and the testing of the knowledge, the comprehension and the confirmation. And as we continue to do this, and as we continue to observe that it's working, I think this feeling eventually starts to build, and that feeling is confidence. So if you are a new trader, I find that new traders, because they don't necessarily have a lot of negative experience already, go through this process fairly quickly. I don't know how long. People ask me how long it's going to take for them to become a trader. I have no idea, because I don't know how quickly you learn something, and I sure don't know how quickly you're going to get into the market, test it out, and get into this process of building the confidence. There's no way to put a timetable on it. Again, new traders tend to go through this process quickly, because the biggest obstacle that I've seen consistently is traders who have been battered by the market, traders who have spent years and years with bad habits and therefore bad trading results, have a harder time getting to confidence because their confidence was so shattered. They don't necessarily have a lot of trust in their analysis of the market. Some traders have had a very rough time and are able to shake it off. Okay? Some traders got into the markets, and you can think about the mid to late 90s, especially the stock market, and they were able to get a lot of confidence for no good reason. The markets continued to climb, and they felt like geniuses. Okay? I'll tell you a story. I was teaching stock day trading, traveling around the country, doing a little bit of that teaching, and I would have rooms full of students who came to me saying, okay, you're the expert, teach me. But because some of these students some of them were making more than I was trading. They were cowboys, and they were being rewarded for it. And I remember starting off a lot of talks when the market started going into distribution on both the S&P, the NASDAQ, and the Dow, telling them that, look, the market's rewarded you for simply doing one thing, which is buying it. And you've been getting away with it. But not every market continues to go up forever. Unless you learn other trading styles and learn something other than buy the dips, you won't be here next year. Whatever job you quit, you're going to be right back at it. And I remember telling people that, and they would laugh at me. You know, oh, teach, what did you make last year? What did you do in this symbol? A lot of cockiness. And I tried to be as honest with them as possible. And sure enough, I know that most of them blew up because they didn't have a clue as to what they were doing. Okay? Take the time to understand that the market has 4 phases. This goes back to psychology again. The market is one big psychological playground. Fear, greed, boredom, and confusion. And we just keep going through that over and over and over and over again. Up markets, down markets, quiet sideways markets, and volatile sideways markets. So part of the process, again, is getting my inner psychology quiet enough that I can observe external psychology, that I can observe the market's psychology. So this is, again, part of that comprehension, that learning process. We confirm that we're understanding what we're doing is working, usually by winning trades. Okay? I will say that, yes, winning trades tend to build the confidence up the most, but I will also tell you that losing trades where you adhere to your risk management should be considered a good trade. It may not be a winning trade, but it should be considered a good trade. Look at trades as good and bad, not winning and losing. If you look at trades as good and bad, you'll realize a good trade is one in which you followed your trading plan, while a bad trade is one in which you did not. Can you win and make a bad trade? Absolutely. In fact, the late 90s were full of people doing that, making lousy trades and winning. And that always ends up the same way, with a crash and burn, because there's nothing that was ever learned, no strategy ever mastered, and it's all about internal psychology and nothing about external. So again, look at trades as good and bad, not as winning and losing, because you could actually make a string of losing trades that could absolutely be good if you adhered to your stop loss, if you adhered to your risk management. Okay? So, again, comprehension plus confirmation equals confidence. And I don't know how long it's going to take you to go through this process. Again, new traders go through it quicker usually. Experienced traders, ones especially who have been battered, go through it more slowly because they're having to nurse their confidence back into some semblance of reliability, some semblance of getting to the point where you visually trust and emotionally trust your analysis. Okay? All right, so, I probably could have told you all that in 5 minutes. C plus C equals C, and good night, right? Well, let's talk about how it applies to systems trading for a moment. Okay? What's the new change in this is this idea of the systems trade. So if I haven't already driven home before throughout this month and the earlier part of our discussion today, is we're taking a discretionary understanding, discretionary approach to the market, and we're basically automating it. I mean, that's the way I look at systems trading. So if I don't have an understanding of what it is I'm doing from a discretionary standpoint, if I don't know the nuts and bolts of it, how the heck do I automate it? Worse, what if I'm buying a system from somebody else? If, for example, I went ahead and cooked up this whole system with my wave and grab, which I trust, okay, and you might have been using on a discretionary basis, but what if I kept it a black box and just had it bling out buys and sells and you had no idea why it was doing it? You bought a black box. People do it all the time. What is, to me, the pitfall in that? A black box. And why am I taking all the time to share this with you? Because in my opinion, you are destined to crash and burn with a black box unless you understand on some level why it's spitting signals out. What environment was it meant to thrive in? And what, at least in some general notion, is it formulating an entry? You don't have to know the details, but unless you know enough to satisfy your comprehension and confirmation, you're going to lose confidence the first time you have a string of drawdowns because you didn't know why it was winning, and sure as heck you don't know why it's losing. That's the challenge. So the transparency here is meant to do what? In my mind, it's back to C plus C equals C. Because if I'm imagining that some of you might use this eventual system, EA, whatever it is, and I'm going to cook up here in the next 30 to 45 days, and you can come back to these sessions and go, okay, that's why it's spitting out a signal. That's the environment that it was meant to thrive in. We've spent a lot of time talking more about trending systems, and I'm likely to create that grab wave combo for trend following, swing trading. That's probably going to be the first iteration of the system that I put together. So when you look back on these, you go, oh, okay, she automated swing trading. I know why she swing trades. I know when she wants to swing trade, and now I've got an automated system that more or less does that. So if I start losing, if you start losing, if the system starts spitting out trades that you have a string of drawdowns on, you can step back and go, okay, this is why. I understand. She was transparent. The system's transparent. Okay? So the colossal joke of buying a black box is that for some reason, temporarily, either because of a track record or who was pitching it, we had confidence. We can jump right to confidence without having comprehension and confirmation. I remember when I first started teaching, some people had read my first book and basically said, oh yeah, whatever you say, that's fine, I'll use that tool. I'm like, whoa, 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 wait a minute. Why are you giving up your confidence so easily? You got to go test this out. You got to challenge me here. You got to go take the time to learn what I'm talking about and test it out in the market and make sure you're seeing it on your own. Oh, no, I trust you. And I appreciated that, of course, but they took that feeling that they knew me or were comfortable with what I was doing and the success I was having, and they thought, okay, I'm confident. I don't need anything else. But what happens? At some point, even when I'm doing stops working right, you got to make some adjustments. You got to use different strategies. If they just learned my swing trading and not my trend reversal, not my distribution fades, not my momentum entries, when the trend trading stopped, when the swing trading stopped working, what happens? The confidence is gone. And because they never took the time for comprehension and confirmation, they've got nothing else to fall back on as far as knowledge to make the necessary changes to adapt. Okay? So don't let your trust in somebody or something make you leapfrog comprehension and confirmation. If you jump right to confidence without putting in the hours and putting in the work, again, the story doesn't end well. Okay? So when it comes to systems trading, if you haven't heard me out so far, what am I telling you? I don't feel black boxes work for the average retail trader, for the average person, unless they were part of the formulating of the black box and have some sort of understanding as to the why, when, and how of it. And at some point when the drawdowns come, it's too easy to lose confidence because you don't know why you were winning in the first place. Okay? So if you want to be a systems trader and you're like me, again, you don't have a whole lot of interest in coding, there are plenty of people out there that will code your system for you, but you've got to have the understanding from a discretionary standpoint to have some of the details we were talking about when I was looking at that Euro-US dollar daily chart, right? We were talking about some specific details as far as how I recognized an uptrend, how much bullish sentiment and momentum was needed for me to say this is an uptrend, and then what levels were acceptable entry levels. In this case, the 20-period simple and the 34 EMA high. All right? So however it is that you're going to communicate to somebody what you want your automation to be, it starts from a level of understanding, comprehension that you have what? Confirmed and now have confidence in. And if it's your system, number one, you can make changes, you can adapt, you know when to shut it off. I'm not going to trend trade in a sideways market. Okay? I have other strategies I could use. But if I don't know how to recognize that market trend, if I don't know what environment that system is designed for, or that strategy even. You know, one of the things I've often said in our talks is if you go to one of these expos or, you know, if you catch another webinar anywhere out in the web or read somebody else's strategy and they're teaching you the step-by-steps of their strategy and they don't tell you what market psychology, what market trend they apply it to, how do you know when to use it? It's like throwing spaghetti at a wall to see what sticks. No way. No way. It's hard enough to trade without not even knowing when to use the right tool, right? So for me, if I'm learning a tool from somebody, one of the first questions, with all due respect, I ask is, okay, that's a cool entry strategy. When do you use it? You know, what market trend, what psychology is that approach meant to capitalize on? Okay? So really the bottom line is, if we know markets can go up, down, and sideways, if we know markets within the sideways market can exhaust that support and resistance or break out and break down, right there, swing trading to the upside, swing trading to the downside, if I have a trend I follow, I must also consider there are trends that will reverse. That's two strategies right there, right? Trend following, trend reversal, breakout and breakdown, and then fading. So that's four strategies, right? To account for the directions that the market can go. And the market can only do those things. There's not a lot of things the market can do. It's not that original a place. Fear, greed, bored, confused. You know, don't make the market to be anything more complicated than that. It's a representation of human psychology graphically portrayed with candles or bar charts or a line chart or an area chart. Those charts, in my opinion, are measurements of human emotion, not the value of anything. We're assigning a value. and our emotions are usually what's assigning the value. Okay? So with that in mind, knowing what you're measuring, knowing what it is that you're trying to accomplish, again, the first step is the acknowledgement of the external psychology. And the only way you're going to be able to measure that is if you can quiet your internal psychology. And the only way you can really handle your emotions, I'm not saying completely shut them off, because again, unless you have Vulcan blood in your system, ain't going to happen, okay, is if you go through this process of comprehension plus confirmation equals confidence. That's the only way you're going to find a certain amount of peace when you are trading. Okay? All right, so let's go ahead and tackle a few questions here. And again, if you're joining me for the first time throughout this month, you know, we've tackled a lot of the topics for this jump that I'm making into taking some of my discretionary trading approaches and automating them. I'm by no means abandoning my discretionary routes. I'm just curious, and I'm curious as to what extent I can, in many ways, make a Raghee robot, if you will. Okay? You guys are going to know exactly what it is that I'm doing, because I'm taking the strategies that I've been teaching for years and years and years, giving everybody the details, the tools, and so forth, and I'm just trying to automate it. Okay? All right, so let me start off with the series of questions that I've got here, and we'll just go right down the list. Okay? All right, so I'm just kind of skipping by already the discussion about where to find the past videos and when the ones in this month will be available. We talked about that at the top of the hour. So let's see, I had a question from, let's see, Brad, who, Paul, who asked to close above the 20. The moving averages on the chart that you see here in front of you are the 20-period simple moving average on the close, the 200-period simple moving average on the close, and then the 3 lines of the wave, the 34 EMA on the high, the 34 EMA on the close, and the 34 EMA on the low. Okay? The 2 white lines are simple moving averages, while the wave is made up of exponential moving averages. So thank you for that question, Paul. Brad asks, I've been recording a new Forex program on CNBC, Money in Motion. A suggestion they offered was to either sell the Euro Swissy or buy the Australian dollar Swiss franc. I went with the Euro trade. Ouch. Down 98 pips right now. What confuses me is that they seem to move almost in parallel, so how could both be a good idea? All right, so that's a little bit off our topic here today, but I think we can talk about psychology and we can talk about this television show. So let me just first of all say that actually one of my very good friends and an excellent trader and Elliott wave technician, Todd Gordon, is on that show. So I'm going to have a very hard time being negative here, you know, because I really just adore him. And I think he's an excellent, excellent trader. So, you know, look, here's the challenge. When anybody gives their ideas for a trade, it goes back to everything we've been talking about today. What time frame? What market trend? What environment? What's the strategy? What are they trying to capitalize on? Okay? So let's jump on over to that Euro Swissy and let's try to, you know, tie it up with what we've been talking about here today. And by the way, have I lost anybody? Is everyone more or less with me here? I know these are conceptual ideas, but you know, I'm not trying to throw a lot of fluff at you. I'm trying to throw some framework around the way it is that you make trading decisions. Okay? I think learning a strategy is pretty simple. The actual process of learning a trading strategy is not difficult. It's understanding when to use it and having the confidence to use it promptly. Okay? It was a great tweet on my Twitter feed today, and I believe I I believe I retweeted it. And it was, let's see, it was by Michael Covell. And he said, he quoted George Jackson, who said, "Patience has its limits. Take it too far, and it's cowardice." And I thought, wow, what a great line for trading. Because how many of us have lacked the confidence? Hey, I'm raising my hand here too. How many of us have lacked the confidence to see something? It's like, oh gosh, I know this is a great trade, but we lack the confidence to hit the button. You know where that comes from? A prior bad trade in terms of not following our rules. A lack of understanding. Nothing paralyzes us more than having no clue as to why we're doing what we're doing. So, you know, don't confuse that lack of taking action with saying, oh, I'm just being patient. Make sure you really know and to be tough with yourself and ask yourself, did I just shortcut my C plus C equals C and didn't take enough time in comprehension and in confirmation? Because, you know, here's another concept. Waiting on the sidelines is absolutely important. Flat is a position to me. But the lack of confidence to act usually stems from some sort of failure to learn and to test. Okay? All right, so let's take a look at this Euro Swissy. And we'll do a little analysis here. Number one, I have no idea what time frame they were trading. And if you follow me on Twitter or look at my Facebook updates or any analysis that I write across the web, if there's a major portal out there, I write for it. You'll see me on all the websites, okay? And one of the things you'll always see me talk about is what time frame, or I'll have a chart accompanying it, what time frame it is that I am analyzing. Because I could have a range-bound market end of day, yet within that range have an intraday uptrend or an intraday downtrend. Or I could have an overall up market like the Euro US dollar right now, but maybe on a 5 or 15 or 30-minute time frame, I could have a move lower. Okay, so you got to talk about which time frame it is you're looking at. That's number one. So I don't know what the setup was. So in all fairness to these recommendations, I don't know what the setup was for the Euro Swissy. All I can tell you is that starting with the directional bias of the daily, let's do this together. What do we see here? A wide range-bound market, very difficult to put your finger on where the exhaustion might be because there's a lot of highs and lows within this, lots of different layers of support and resistance, but this is a classic ugly distribution market trend to me, okay? Which means that I've got a 2 to 4 o'clock wave, I've got multiple highs and lows that are leading me to believe that there are multiple levels of possible exhaustion at floors and ceilings. This is always an aggressive setup, and I've also got some really active resistance at this 200 period simple swooping down across this time frame. There is no more psychologically relevant a combination of time frame and indicator setting as a daily chart 200 period simple moving average. Just my opinion, but I don't know of anything more psychologically relevant than that combination right there. It's that well followed. All right. So for me, I'd be looking for exhaustion. The first level of exhaustion for me is pretty much where we're at right now, this area right there. There's another layer of exhaustion that we could see right about here. And then finally, we have another layer of exhaustion way up there. One of the ways that I will try to determine what it is I'm trying to accomplish with these multiple layers of exhaustion is trying to determine, making sure that this is indeed a distribution market trend, okay? Or congestion. I know a lot of people have a very difficult time wrapping their heads around distribution at the bottom of a downtrend on the chart, but it's actually distribution for what? It's actually distribution for the euro in many ways, right? Think about, well, I'm not sorry, not for the euro, I'm sorry, for the Swissy in many ways, okay? It's one side of the pair is bullish, right? There's always a bullish side of any trend, okay? So which one of the pairs is in distribution? I think distribution absolutely can apply to Forex pairs. Even though we're at the bottom of a trend here, I think that can absolutely apply. So Within a distribution market trend, I'm looking for exhaustion. I'm looking for that failure at a ceiling or at a floor. So we're nearing the ceiling, so that's why I'm focusing on it. How do I confirm that? Well, one of the ways I like to do it is with an oscillator, and that's the stochastic oscillator. I use a 2113 setting, 2080 overbought, oversold, and there we go. So what I want to see is that prices could be nearing a level at which we're overbought on the stochastic as we're reaching the layer of resistance. There are multiple layers here. I have to acknowledge that we could head up to this high back here. Okay, but for now it looks like the stochastic is confirming that we are nearing an overbought area. So I'll look for basically exhaustion within these two lower red lines. So when my directional bias in the daily chart is lacking a trend, I've got to acknowledge that if I'm looking to get long or short, that a long position may start to exhaust based upon where we've exhausted before, and that a short position might benefit from the shift in sentiment. And that's if I look intraday. But end of day, there is no clear trend. I don't care that we've rallied up this far. According to the wave, in my interpretation, there is no clear trend currently on the daily Euro Swissy. Okay? So in terms of selling this, okay, I don't necessarily disagree with a short sell here. This would essentially be a distribution fade to me. Where am I looking to sell it? Well, if I blow this chart up a little bit, I want to look at some of these past highs. You know, some of the aggressive levels would be highs at 30.20. There's a high back here at 30.38. Okay, I've got a high back here at 30.35, 30.43. This high back here is 30.67. So just from the numbers that I've just thrown out there, from where these past highs were, we're basically looking at a area of 30.28 to 30, what was it, 30.67 I said? Yeah, that area, 30.28 to 30.67, under which I will look to go ahead and short sell. And not until I get the confirmation of that overbought stochastic. So could there have been lower levels of this range in this little area here? You know, there could have been levels that were a little bit more aggressive than that. You know, I think if I'm so close to that 3,000 level, you know, that could be another level I could consider. Okay, I know these whole round numbers can sometimes act as much as magnets as they can as resistance levels. I don't know what price at which they recommended. I don't even know that they mentioned a price, or under what situation you would go ahead and put in some sort of conditional order or market order. So again, it's kind of hard for me to judge, but I don't know that I would get in any more aggressively than 3,000. And you saw where the resistance all stacked up in between that 28 level and 67. So basically prices will kind of gravitate to that whole round number, and then my expectation is it will likely exhaust at that point. The confirmation for that for me is the past highs and the overbought stochastic. Okay, so I don't disagree, but to me price, price matters. A good entry makes for a much easier to manage trade. So getting in too aggressively. Remember what I talked about earlier, position sizing? If they were recommending getting short this market a little aggressively with the expectation we may not make it to 3,000, fine. But acknowledge that we could make it up there. So I recommend to the listeners, readers, watchers, viewers, whatever, maybe a 1/4, 1/3 type aggressive entry with a, say, 3/4, 1/2, or 2/3 conservative entry. Let them know where the layers of resistance are, and let them know there are multiple levels of aggressive to conservative entries into which the position can be entered. Does that make sense to everybody? Okay, so then there's the buy the Aussie Swissy. Now, let me also mention, I'm not necessarily a great fan of a lot of these cross rates. My prime time for trading is actually really coinciding with the overlap of the Paris, Frankfurt, London, and U.S. markets. So Eastern time, about 7 a.m., 8 a.m. to about 11 noon. That's basically my bread and butter time because I'm gauging risk appetite, risk aversion with the dollar and the Dow, and then therefore the majors and the COMDOLs that trade against the dollar, which are, generally speaking, if you look at the Bank of International Settlements, where most of the trading volume, liquidity, that turnover takes place. I'm staying with those very, very liquid pairs. It's kind of ridiculous for me to say that there's an illiquid market in Forex, but comparatively, there are illiquid markets. You understand what I mean? So starting with the daily chart, getting an idea of the directional bias. Why the daily? Because basically what happens is the daily or end of day time frame, I believe, is the most psychologically significant. Therefore, I want to understand what that overall daily market trend or market sentiment is, what that psychology is, before I make any kind of judgment call as to which intraday setups I might take. Understanding the daily chart's direction lets me know if my intraday setups are moving with that daily psychologically significant trend or going counter. Okay, I think a very big distinction. So Aussie Swissy, again, you're talking about two very strong pairs, and it's a foot race to see who's stronger, right? Start with that daily chart. One of the first things you can do to filter in or out a pair that you're going to trade is if you can't determine what the major dominant psychology is by looking at the daily, you might want to leave it alone. Use the grab candles, use the wave. I think we're in a fresh uptrend here. I think that if I were to use some of the criteria we talked about earlier in the session, consecutive green grab candles, the angle of the wave, this could be considered a very fresh, slightly aggressive, okay, markup trend. Okay, so for me, and again, the question, this all stemmed from a question Brad asked. Okay, if you take a look at the chat board, you'll see these questions scroll in the chat window that you have, and their recommendation was to do what? Buy the Aussie Swissy. I don't necessarily disagree with the Aussie Swissy buy. Again, where? You know, what time frame and where? A buy would be at least somewhat in sync with the bullish sentiment and momentum and this what seems to be a fresh uptrend. So, you know, which time frame? Which setup? You know, again, very difficult to determine without that knowledge. But I hope you guys can see that's the process by which I would look at any recommendation given to me by anybody. Okay? All right. Question here from Les asked, do I ever look at fundamental analysis as part of my confirmation or technical? Well, Les and anybody here in the room, if you read my Daily Trading Edge at ibfx.com, you realize that you'll see that a lot of my analysis does include, you know, discussions of different fundamentals that I see swirling about the market. The challenge with fundamentals is, one, they should not be ignored. I'm not just a price-based technician. I know a lot of technicians would just assume ignore fundamentals, but what I do is I try to read as much as I can about what's going on in the markets, and then I see what's being discounted. In other words, if I read a story and my interpretation of that story is bullish or bearish, and I want to know if that's being discounted into the market, I'll look at the price direction. I think trading on fundamentals alone is, again, this is coming from someone who relies on charts and price action predominantly, so take what I'm about to say with a grain of salt. But I find it very difficult to say that successful trading can be 80% fundamentals and 20% price. I think it's the other way around. Because there is no fundamental piece of knowledge out there, I believe, that I'm going to be privy to first. That's the first assumption. So if I'm not the first one to know it, to what degree has it already been baked into the cake? I'm only going to know that by looking at price action. If it's already been baked into the cake, at that point, is it really something that's actionable any longer? Okay? How do I know which bit of news is being discounted? How do I know I've read or interpreted a piece of news or economic data and interpreted it correctly? Correctly meaning in the way that most of the market participants have also interpreted it. How many times have you seen an economic release come out better than expected and a market sells off? Or in line and a market sells off? It has everything to do with discounting. So again, without some sort of measurement of price, I don't know that fundamental analysis can be adequately, or I should say, correctly applied. But I don't ignore fundamentals. In fact, if you read the DTE, I do spend quite a bit of time discussing some of the fundamentals. In fact, one of the recent DTEs about the euro-US dollar, I believe it was, I spent a lot of time actually taking a fairly contrary approach to the fiber. I put out about 2 days ago, setting up shorts in the Swissy and buys on the euro when they were pulling back. And a lot of people were looking at all the negative fundamentals that were swirling about. But right now, the euro is being pushed and pulled by negative and positive fundamentals. You have debt crisis information on one hand, which is very bearish. You've got the April 7th expectation of a rate hike, very bullish. So sometimes you have fundamentals that are opposing. How do you know which one's being discounted? You got to look at price. So thank you very much for that question, Les. Got another question here from Mingying who asks, do I feel that a lot of my winning trades are due to discretion of each individual trade rather than my usual system? Well, number one, if I'm interpreting the first part of your question correctly, it presupposes that sometimes I just kind of, maybe I'm not understanding the question right, but I always use my methodologies. My methodology might be considered discretionary, but it's a methodology. There are rules and steps to them. I just don't do them automatically, which is what's usually the connotation of a system. Okay? So yes, it's discretionary, but my discretionary trading has a series of steps, has a series of rules that I guide them by. So there's a consistency there. Okay? For example, the recent euro-US dollar trade, my limit orders were not triggered because it didn't retrace the 20-period simple or 34 EMA. It did, by the way, retrace to the 38.2 Fibonacci. Okay, but you're right, it did not retrace to either one of those moving averages. But then my 4X AM later, I realized that I used a Fibo, right, for my aggro level and managed to enter during a retracement. Might I add, Mingying, that my entry was 1/4 of my typical position size because that was such an aggressive level. So 20-period simple is always aggressive. The Fibo, the 38.2 retracement, was fairly aggressive. So it was at 1/4. So I spend a lot of time discussing the 20-period and the wave, mainly because they are probably the most mechanical in terms of the entries. Well, I know Fibonacci is one tool that not a lot of traders utilize, and not a lot of traders are comfortable with because of how subjective it is. So I do use that. You know, there's psychological levels I'll consider for swing trades, Fibonacci levels, and of course the 20-period simple and the wave itself. So it was an aggressive level. You're correct. And therefore, the market took off with me basically only being at 1/4 of my typical position size. And so that's not really discretion to me. Those are just alternate levels that I don't necessarily talk about a lot because they are so very subjective. So let me finish the rest of your question there. Well, you know, it's not unusual. I've discussed it many times, maybe not recently, because I've been trying to, you know, we've been talking about systemized approaches the last month, and I don't know of any way to really systematize Fibonacci, okay? So another example was the cable swing trade, where because of my experience, I put in a cheated stop loss due to the increased number of retracements. You know, I think you're right, but again, as we were talking about the cable, if you were following me on the 4XAM program, those were things I was mentioning that we have to consider, because as that cable got toppy, as the area between the ceiling that we were dealing with and the climbing wave, for those of you that remember that look at the daily cable, we ended up with less and less potential upside because of the way the trending wave was basically butting up against the 6,200 area, the 6,300 area. And what happened is I was more and more concerned about exhaustion. Eventually it broke out, but you know, I didn't know that, and nor was I going to assume it was going to. But one of the things we discussed on the show was the fact that I was running out of potential follow-through. So just to make the risk-reward ratio work, I had to cheat it in. So yes, those are somewhat discretionary decisions, but there is a set of guidelines and rules, like having a balanced risk-reward, like recognizing that an entry, a swing entry, is so close to a ceiling, therefore, I may not be able to use the point of validity as a stop loss. I may have to consider balancing out the fact that the ceiling is so close overhead with a cheated in stop. And those are excellent examples, Ming-Ying, by the way, excellent examples of times where I had to look at the current market, use the guidelines that I've talked about in the past, but you're right, they're not usual in terms of things we always talk about. They're adaptive. And that is an excellent example of how difficult it can be, but at the same time, why it's so important when you are a discretionary trader to acknowledge, like, for example, and by the way, gang, what we're talking about, if you take a look at this chart, before we had broken out, this was the situation we had, okay, with that ceiling overhead, and you can notice swing trades back here had plenty of room to run, okay? And the closer we put on, and by the way, this is what's happening in the Euro-US dollar right now, okay? This is happening in the Euro-US dollar right now. We had the ceiling overhead, the waves climbing up, and I believe my update today was called the price squeeze. This is a price squeeze. I'm not going to assume a fresh high, okay? But I do have to balance out the fact that I'm having less and less room for upside follow-through as the wave squeezes up against the ceiling. Okay, so we're seeing that right now. Let me show you a current look at that, because I think that's a terrific example. We're seeing that right now in the fiber. Okay? So great point, and similar situation, no? Do you see the similarity? So yes, at this point I'm going to start to override my typical thinking and say, you know what? I have this ceiling overhead. I'm not going to set up a trade that absolutely requires some sort of follow-through through these highs. I'm going to have to adapt and make sure I acknowledge a slippery slope that the fiber is in right now. Okay? So thank you very much for that thoughtful question, Ming-Ying. Excellent question. I probably could have done a webinar just, frankly, on that question alone. Okay? All right, let me wrap up a few more of these questions here. I know I'm running over. So let's see. Where do I see the Euro-US dollar going today? Read my daily trading edge. You can see exactly what I'm thinking about the fiber. Can we use my system 34 EMA on a 1-minute time frame? Alex, due to the cost per trade, namely the spread, I typically don't like to trade time frames shorter than a 5. But yes, I'm measuring psychology, right? So if you're measuring a very, very short-term psychology, yes, you can. But just keep in mind that at some point the cost per trade in a very, very small time frame, I think, will erode into your potential profits of your trade. For me, it's just too short a time frame. Okay? 5 minutes as small as I go, and you can check out my Between the Greens approach for that. All right, so thank you for that question. How much time or candles does the wave or candles have to go over or under the 200 EMA to tell me the trend is changing? I don't use the 200 EMA to say the trend is changing. The wave, yes, not the 200 EMA. So to answer that question, how much? A trend shift for me will come either if the angle of the wave loses its steepness in a downtrend or uptrend, or if we pop through the other side. So for example, let's look at the Euro-US dollar here. I believe this to be an uptrend. I would change my opinion if the wave starts to lose that 12 to 2 o'clock angle and flatten out, or if price action breaks down below the 34 EMA. Okay? An override would come if there was some sort of significant support or resistance that was below the 34 EMA, like a 000 psychological level, or some sort of support that had been very key and hit earlier. Okay? Then I might reconsider giving a little bit more wiggle, but once it breaks, it breaks. And for me, the close certainly would be important below that, but I can't say there's a magical way to 100% say that, yes, this particular move absolutely has changed the sentiment of the market, but I can, again, what I will rely on is a change in the angle of the wave, or, for example, look at the past reversal here. We went from green to blue to red. So it didn't happen all of a sudden. We went from bullish sentiment and momentum to neutral than to red. So the neutral may not have been enough to say that the trend was over. In fact, sometimes neutral candles are simply corrections. The red candle, yes, at that point, sentiment has gone negative, momentum has gone negative, and my red grab candles indicate that I'm in the very early stages of what could be a shift to that downtrend. So thank you very much for that question. Again, it's not the 200 period. It's not the 200 period SMA. It's the wave itself as far as trend changes. Okay, 200 period SMA just happens to be a very important moving average to watch. Okay. All right. So the additional considerations, absolutely, Min Ying. I hope I answered that in your earlier in your question. Again, thank you everybody for your questions. I really, really appreciate it. If you have any questions about grab or the wave or any entries, again, I invite you to head on over to the YouTube channel and catch some of those replays. We'll have next month's topics out sometime next week. And again, I've gone way over, so thanks for your patience hanging out with me here. I really appreciate the questions. I appreciate you all showing up. As always, I look forward to this every week. I enjoy our conversations, and hopefully you guys are benefiting from it too. Don't forget, Daily Trading Edge every single day at ibfx.com. We have some very cool stuff. I wish I could tell you today, but some very cool stuff in store where we're going to have a place, more frequent updates of what I'm doing, more ways to interact. I'm super excited. You guys will actually see that, I think, in about 2 weeks. Can't wait to share that with you next month. Okay? Super excited about what we've got in the works. The good folks over at IBFX have just really, given me all sorts of help and staff to kind of make some of my dreams as far as a central hub for analysis come true. And like I said, I'm just stoked out of my mind. Got back from Salt Lake City this week after some great meetings. And again, I always love visiting the mothership. I love visiting IBFX HQ because they always let me run with some of these ideas. So again, I hope you guys benefit from them. Thank you as always. I will see you, I think, week after next. We have an off week. I'll see you the second week of April. All right? Okay, look out for those emails and the topics and times will be coming at you. Thanks as always, and I'll see you next time.